Are you or your clients looking for a regular income solution with compelling returns to diversify your portfolio? If so, Neighborhood Holdings may be a great option for you. Listeners of this podcast will appreciate that public markets can be turbulent and finding a good private credit fund can be tough. But Neighborhood's track record, transparency, and investor alignment sets it apart from the pack. With nearly 10 years of consistent performance and a target net yield of 8 to 10%, Neighborhood has a track record of providing monthly income to investors without the volatility of public markets. How do they do this? Where banks invest in mortgages up to 95% loan to value, they also make borrowers jump through a lot of hoops. Many borrowers in transition aren't able to meet those hoops. Neighborhood has partnered with banks and brokers to provide quality borrowers with temporary financing secured by first mortgages at an average loan to value of less than 60%. Where other mortgage funds might take more risk by lending against construction, bare land, or jumbo loans, Neighborhood is focused on your average residential borrower who owns the average house in the neighborhood. Plus, their variable rate with a floor mortgage pricing benefits investors when interest rates go up and mitigates downside risk. Check out the link in the description or visit neighborhoodholdings.com to view the offering memorandum or speak to your financial advisor for more information. That's neighborhoodholdings.com/Loonie Hour. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 165. As always, joined by the three amigos, Boomer, Deep Ticker IceCap Asset Management, Rich Diaz. What's going on?
Well, guys, we are in the second last week of the quiz night, trivia night. Almost done. I know. Boomer came through last night. So it was a tie at the end. So you have one schmuck from each team has to stand up in front of the room and write down without help from your team the answer, and then whoever is the close, like the Price is Right, whoever's the closest wins. And I happen to be last in line, so I had see how it all dealt. But the question was, how long is the Great Wall of China? So in kilometers. So I'm sitting there, I'm like, man, this is an easy one. I got
264.
No.
264 kilometers?
Thousands.
How many do you think, Rich? Oh, Rich is like looking it up, of course.
No. It's 2,500 kilometers.
Okay, so like the first schmuck says 271. And I'm like, this guy's not going to win. And next guy, no, it's more, it's 800. And then some other dude says, I'm going to go with 725. And then the lady next to me, she says 2,000. And the whole room went, is that a gasp? Gasp? How do you pronounce? What is that, Rich?
Gasp.
Can you do that?
Yeah, but keep going.
You're not going to do it. I come out with my number. I'm like 14,000. And the whole room I just dropped the mic and they were like, are you kidding me? No way.
14,001, Bob.
Kilometers. And then the answer is, what's the answer? Rich, have you pulled up now? Is it 18,000?
I didn't pull it up.
22 or something?
What's the answer?
My guess is 2,500.
No, it's almost 20,000, I think. If you
what?
Look at it. Yes, it's a big one.
Is it actually?
It's big, man.
Wow, this is now the Chinese economics podcast.
You're thinking it's like the Lions Gate Bridge or something. Like this thing can be seen from outer space.
20? No, that's a lie, by the way. It's 20. That's like a myth. It cannot. It's 21,000 kilometers. Holy moly. 22,000 kilometers.
Imagine building that thing. It'd take like 100 years today.
In
Canada, you know how long that would take to build?
How many permits would be needed to build that? I'm taking the Saskatchewan portion. That's what I'm going to take. I don't want to touch anything else.
Hey, speaking of building, so the Toronto new construction home sales, I think I've told you guys this, but they're running at 27-year lows. So developers trying to like pre-sell condo units at 27-year lows. Of course, the government promised us they're going to build 3.9 million homes by 2030. So, but if you kind of unpack that a little bit further, there's a couple charts have been circulating. So based on like kind of where housing starts are at today, so if you can kind of model out where pre-sales are at. Because you're not hitting your pre-sales, you're not able to get the financing to then start the construction of new housing. And so they've actually modeled it out where new completions in the GTA are literally going to like 0 by 2030. It's nuts.
I mean, that's also wrong.
It's actually like unbelievable.
But
New
that's also
condo
wrong.
expected completions. Again, obviously, yeah, hey, maybe things can change in the next couple of years, but it takes like 4 or 5 years to build a tower, right? So unless something changes pretty quick, your new home completions in the GTA are going to be close to 0. Like 376 units is what this chart's showing, but
Wild.
Imagine if the GTA were in charge of building the Great Wall of China back in the day.
Doug Ford, baby.
Man,
Also,
Mongolia
I
would have been flowing in through the border. The border
It's
is
a
wide open.
misnomer. It's a misnomer. It's a misnomer because it's Great Walls of China. There are many different walls. I'm looking at the map
Is there a couple?
now.
There's a couple holes in the wall.
Yeah, there's a bunch of walls. It's not just one wall. There's many,
Couple-
many, many walls.
Couple gaps, eh?
Anyways,
Missed a few
So
spots.
Rich would have been on the team that guessed 200 kilometers, and now he's protesting because
no,
he
I
was.
said. Oh. Anyways.
Anyway, so that's what's happening in the pre-construction, which leads to ultimately, I mean, I don't know what's going to happen to all the people that are employed in the construction sector building those things, because that seems like it might be a problem. But I guess that's Tiff Macklem's problem to worry about, which we'll get into next week. What are the odds, Boomer? Bank of Canada next week.
Well, I have a question. What about the rest of Canada? I know you don't care about the rest of Canada, but like, what's going on in like Calgary and Montreal and all these other,
So yeah, I mean, if you look at like housing starts year to date, I mean, housing starts again aren't necessarily like a leading indicator, but they're, I guess, as good as we can kind of get, unless you're strictly looking at pre-sale data. So all the home building, all the housing starts this year are pretty much exclusively like in Alberta, and Rich a little bit in Quebec. So Alberta is pretty much holding up, that combined with the oil and gas sector is pretty much holding up this entire country right now.
There's some irony with that, isn't there?
Yes, definitely.
Housing starts are down dramatically in the GT in Ontario and then BC as well. So, yeah, the growth stories in Alberta still is. I mean, we'll see how long that holds up, but that's what the growth is.
Okay, because I was looking at Montreal, and Montreal is actually doing pretty well with the condo starts and the housing starts. It's actually, I mean, Quebec, my goodness, for once we're.
I think that's going to change though. I think like that housing market is soft-ish. That
okay.
housing starts, people have to remember, like if you're building a condo building in Vancouver, Toronto, Montreal, it takes you like 3 years to go from like concept to housing start. And sometimes it's like 5, 6, 7 years, depending on like the size of the tower. Because think about it, you got to acquire the land, then you got to get it rezoned and go through all that permitting process in Canada, which is a disaster. Then you got to pre-sell the units. And then once you pre-sell the units, you get the financing to actually put the shovel in the ground, which then becomes the housing start. So like housing starts are really just a reflection of the sentiment in the development community from 3 or 4 years ago.
Yeah, like a lagging indicator.
It's a lagging indicator. It's just like, and as we know, if you look at the housing starts by component, it's particularly in the GTA and Vancouver, like we don't really build single family houses anymore.
Oh.
So
Who
the
would want
housing
a single
starts
family house? Who would want one?
I mean, 3 million plus for a new house in Vancouver. So basically nobody builds them anymore. And what we build is predominantly multifamily condos, townhouses, and those take a lot longer to start and complete. So it's ultimately like a lagging indicator.
Oh, we're fucked.
So does it seem like now we're sort of in this like holding pattern, Steve, like with the housing market, or like is it the outlook better? Because if it's going to take 3 to 7 years, to get something going, would a developer who had, say, they're not trying to finish a current project, and like a few lads they raised the capital, would that deem to be a good time today? Hey, let's start this because no one else is doing it. Maybe we can get some assistance, on the policy side and stuff. Or are we not there yet? Are we just not there
I
yet?
don't think we're there. No, I mean, like, definitely not. I mean, we've got a record number of units under construction. So you got like the pipeline's still full, right? Like the units that were launched years
The
ago.
shitter's full. The shitter's full.
It's full. And so the units, so like you have like a record number of home completions that are coming up in the next 12 to 24 months at a time when the economy stinks, sentiment's sour. We're just told that immigration's or population growth is going to go to zero apparently over the next couple of years. And so you're like, well, what's the outcome or what's the outlook? House prices are already flat, rents are declining. So I think if you're about to deploy, tens or hundreds of millions of dollars on a new project, yeah, I don't think it's time yet. So
Okay. So
Okay.
Steve is not calling the bottom in this market.
not on the development side, but I mean on the resale market, and you guys, we joked about this like a year plus ago where I said, listen, like from a sentiment perspective, best deals. That was really at the end of 2022. And so if we look at the data that's come out here for Toronto for the month of November, home sales were up 40% year over year. Huge jump, obviously coming off of basically record lows. So the overall sales component's still really low. But prices they were down 1% year over year, the home price index.
And Steve, what about the I will call it the renovation market? Because these days you buy, unless you're buying something brand new, you got to put a bit of money into it. And I know down this way, you are months, sometimes a year, trying to book a contractor, to get in. But it is getting softer here now. It is getting easier to find someone to get things done. Is that the same out your way?
Yeah, there's some slack. There's a bit more. There's definitely a lot more availability. Guys aren't as busy anymore. The renovation dollars have definitely slowed down, right? I mean, I think there's a lot of people that will refinance to do a renovation or borrow on a home equity line of credit. So I think when that money gets more expensive, that's been the anecdotal conversation that I've had with contractors. Shouldn't be surprising. I think there's just less money available today. So,
okay. So this trend hasn't changed. This trend continues.
No, yeah. I mean, if you look at like Vancouver stats came out as well, like again, sales are up 29% year over year. And so everyone, like, the media, of course, is saying, oh, see, Bank of Canada cuts rates, housing market's back on fire. We told you. And it's like, guys, like, so you look at the Vancouver sales, yeah, they're up 29% year over year. But again, they're still below the 10-year average. Like they're getting back to normalizing. They're getting back to sort of their longer term trend. But they're still soft. Inventory's still high. Prices were down 1% year over year. So like it's kind of a flat dull market. Not a whole lot to report. The real problems in the Canadian housing space, if you're looking for fire, it's in the new development and construction space. That's where you're going to see your delinquencies. That's where you're seeing your problems. That's where you're seeing the losses compound. Investors that bought near the peaks in 2021, 2022 that are closing on pre-construction. I'll give you one example. This is great because I've been really following this building. There's a building in Vancouver called the Kengo Kuma. It's a fancy building. It's a developer that's notorious for selling projects offshore. So he really tapped into sort of the Chinese luxury market. And he's got another tower that completes in about 3 to 6 months. Anyways, this is like, he just finished this tower a couple of years ago. This is like the comp. So it's called the Kengo Kuma building. And basically they pre-sold in like 2016 near the top of the downtown condo market. They pre-sold, like the blended average, it was like $2,500 a foot, like crazy numbers. And it completed last summer. And since it completed, there's been like 40, 50 units that have come to market, but nothing is really resold. There's been like 2 sales because basically everyone's facing these huge losses, but nobody wants to accept the bid. Right. So people are like, well, I'm okay to lose like $100,000, maybe like $200,000, but like, I'm not okay to lose $600,000, $700,000, because that's what it takes to get out. Like that's the market clearing price. That's where the bids are coming in at, but nobody wants to accept those. So everyone's just kind of languishing on the market, pulling them off, trying to rent them out, putting them back on. So there's one that just cleared finally. So there's been 3 sales since the building closed. So get this. So it was a 2-bed, 2-bath, 1,100 square feet, middle of the building, nothing spectacular. Like honestly, not even really much of a view. And it was pre-sold for 2.7 million back in like 2016, 2017.
Canadian?
Yeah, Canadian.
No, they were Chinese.
But they paid Canadian dollars.
Dollars. Yeah. Sorry.
2.7 Canadian dollars. It just resold for 1.8.
Yikes. Loonie Hour math is like a 35-40% decline.
But like, so 2.7, but then you're paying, think about this, you're paying GST, you're paying property transfer tax, and then you're paying realtor fees. So that's 5, 6, 7. That's another 10% in fees and taxes. On top
Another
of
180 that you what?
No, so 2.7, right? When you bought it at 2.7.
Oh, that's on the okay. So another question for you then.
Yeah.
How would someone else create a market to give them liquidity, or does it even exist?
Doesn't exist.
It doesn't exist.
Like how do you give them liquidity?
I know if I walk in there and I know that this situation exists. Like how would I find pre-sold condos that are either not finished or about
I see
to
what
finish?
you're saying. Like, hey, what are you saying? Like, hey, you don't want to you don't want to close? Like, let me.
Let me buy it. Like this is
okay. Yeah. Okay, that's a good question.
Yeah, like
the problem is like, okay, I'll give you like this example, right? Let's just say you entered in the contract, you pre-bought it for 2,500 a foot, and you're like, well, I put down 20%, so if you just give me my deposits back, I will forfeit my deposit. You take the unit and close on it. It's not even worth the 20% discount, right?
Yikes.
So it's like,
but there has to be a price somewhere, because somebody out there somewhere waiting for someone.
but it's not even a deal. It's not even a deal if you just.
Wait, I have a different question. Why aren't these things just being rented out? And like,
but they're being rented at a lower price than what their cash out.
Okay,
I get it. But
okay, Rich, let's play this out. So you bought it for 2.7 plus fees, taxes. So let's just say you're all into this thing for 3 mil.
Yeah.
This unit probably rents for like $6,000 a month.
Okay. So
I mean, I don't know what your holding costs on this, but assuming you put down 25% ish, 30% down payment, you're gonna be bleeding. I would say minimum $5,000 a month. I'd have to run the numbers, but so
this is a massively negative equity position. What you're saying? How come we aren't seeing? You remember in 2008, 9, there was like people would just walk away from these. Not in Canada, but in the U.S., people walk away from properties. Are you seeing people just in droves walking away from this? I mean, if you're in massively negative equity position, that's the right thing to do, isn't it?
Yeah. There's a lot of rumors swirling around, even like this building, that there was a decent chunk of people that didn't close. Again, I can't necessarily confirm that on the pod here, but
crazy
that so Dan Foch, who runs the Canadian Real Estate Podcast, he was at our live Loonie Hour event in Toronto. So I had a good chat with him the other day, because I get these email inquiries from people all the time, being like, hey, this is my financial situation. I bought this pre-sale. What do you think I should do? And I'm like, well, I'm not a GTA guy, but like, I'm happy to jump on a phone call for 5-10 minutes and just talk it through and try to point you in the right direction. So I do get a lot of these situations. And so anyways, I was connecting with Dan and chatting about it. And I was like, man, like, what are you seeing over there? And he's like, I'm estimating, this is a numbers guy. He estimates there's about 100,000 pre-sales that are like underwater in the GTA.
Holy shit.
He's like, there's 100,000 that need to complete over the next, call it 24 months, that are like a real. So people are going to be facing this situation. It's a problem.
Our negative equity. That's the language, right? they've put in more than they're set to gain. Or yeah, that's right. They are underwater on this investment basically.
So let's do some Loonie Hour math. So we
Uh-oh.
have 100,000. And what's the average price value, what initial price of these condos? 800, 500, 1.3?
It just depends. It's all over the place.
$1 million. Let's do $1 million.
Let's do 1 million. This is like the Great Wall of China calculation, right?
There's more than one wall.
Oh man, I forgot to hit the times button.
Okay,
And now it's just
terrible.
one big F up.
This is like painting on a radio show.
100,000 carry to 1.
Save us, Steve.
And like a 30% discount?
Yeah.
Like 30 billion in
That's,
unrealized losses? Does that make sense?
yeah, it
That's
does
too
make
many
sense.
zeros.
I mean,
I don't
who's
know.
holding
Anyways,
this
people-
debt? But like, one more question before we move on mercifully from the subject, which is like, who's holding the debt here? Is it these private lenders, these secondary sort of?
Well, no,
bridge?
who's holding the debt on these is the whatever bank funded the developer's
Right.
construction. Because if the
Right.
developer gets a whole bunch of people walking from deposits and they don't close, I mean,
Wild. So
That-
should we expect more shenanigans out of this government? So, a couple of months ago, we got they increased that 95% loan to value thing from 1 million to 1.5
yeah,
million.
like guys, like yeah, and this is what I said from the get go, right? Is like this is not a policy decision to help the first time home buyer. It's a policy decision that's going to try to help the pre-construction market and people that need to close. So yeah, it's not. The timing is obvious. I mean, you bring this in when you see the writing on the wall, and anyone that's paying attention that's in the space knows there's a real problem, and it's particularly focused in the GTA.
Yeah. Well, I mean, do we expect? I mean, so looking forward, like in the next year, I mean, who knows what's going to happen with the election? But let's just say they have, let's say, another runway of 10 months or so. Do you expect more kind of policies around this?
Yeah, I just don't know how I don't know how they're going to do it. I don't
Okay.
know. I mean,
Okay.
I think sometimes they should let the free market play out. Of course, they probably won't. But
You're laughing now. They're absolutely not interested in that. Keith,
So anyways,
why, Keith? Because they are.
Well, that's why I normally bring out the commie word.
Keith, I want to get your thoughts shortly here on sort of think about all the stuff that we just talked about in the development side. I think that kind of leads into our Canadian bank earnings that we had this week.
Right.
Is there anything that you kind of draw from those bank earnings this week? I mean, it's funny, right? Because like I look at this, what's happening in the real estate development space. Yeah, that the resale market's recovering. It's looking a lot better, but I'm like, man, there's still a lot of problems in the construction space, and a lot of these big banks are, they have those loans. But you look at the return in the stock market on these big Canadian banks. I mean, they're roofing.
Yeah, I mean, just first of all, just sort of set it up first. Bank earnings are very different than earnings from, say, tech companies or industrial or consumer healthcare, you name it, because the banks have many more opportunities to show flexibility with expenses than other companies. So if you're a Caterpillar and you're selling diggers and stuff, and you have some opportunities to do a bit of smoothing on the expense side, but not like banks. So that's why when you see a bank report their earnings, sometimes their actual earnings versus estimates, it could be an incredible blowout number. Like the analyst estimates are never close to what's actually reported, for banks usually. Whereas for someone, again, like Caterpillar or, the tech companies, usually they're pretty close to what they're going to do. So with the bank earnings this week, they're sort of, around a little bit, but the main thing that jumped out to us was that the provision for credit losses or loan loss provisioning. I'm an old school guy, so we used to call it loan loss provisioning. I think now they've changed it to provision for credit losses. I think for 3 of them, the banks provision a little bit less than what analysts were expecting. So that helps their earnings, gives them a boost to earnings. Bank of Montreal, they're provisioning for credit losses. The analysts were expecting about $1 billion, and they come out with $1.5 billion. They just
Wow.
blew, yeah. And people say, "Oh, what the hell happened there?" you know, and on the face of it, it's like, then they missed their estimates, of course, and oh, this is horrible. Sometimes if you're gonna have if you haven't been provisioning enough, or something else bad is happening, and instead of just missing by a little, it's like the kitchen sink, right? You just throw everything out and do it. So Bank of Montreal, they clearly significantly increased their provisioning for credit losses. I can't tell though whether a lot of that is from the US or Canadian side, or a bit of both. So it's not giving us clear visibility where the problem is. Maybe it has to do with one of the recent acquisitions, but I can't tell you right now. But overall, their earnings, their provisioning for credit loss, it's still increasing, Steve. It's still going higher, but they're not hitting the panic button for any reason. They're still increasing dividends. Stock prices are doing well. We'll talk a little bit about that as well. But they're the only big thing. TD, they had some. I think most people know they got put in the penalty box for allegedly laundering money. I don't think they actually, yeah, that's the word we need to use. So check out their story today, which was very different than everyone else. So that's not a credit story. They have their own other story going on. But that's it. Like, there's nothing alarming happening with the banks, but they're still putting aside more money, for credit losses. And banks are banks, that's what they do. They're always going to try to lend. And the best thing you can do if you're a bank, you can lend. If you don't like it, you try to sell off that loan book to some other poor schmuck. And that happens.
Keith,
that's one thing you want to look for all the time.
But Keith, Steve touched on something that was really important, which is the equity market in Canada is doing really, really well. And it's about 34% of the equity market in Canada's financials. And most of that is banks. And they're up 27% this year to date, which is incredible. And we're seeing just in really, really sort of an outperformance of their earnings. Now you can like those earnings or not, but those forward earnings estimates are rising and not falling, despite the fact those provisions are falling. Sorry, those provisions are rising, but those forward earnings are rising as well. So it's just really amazing how it's just shrugging off all this bad news around the real estate industry. Maybe they have enough reserves and they're just totally fine. The other way of looking at it is, nominal GDP is a hell of a drug. You just added 1.2 million people to overpay on their ATM fees and all the other stuff that they have. So I don't know.
Maybe one of these days they'll discover that earnings are just not linked to stock prices.
Yes.
Ever been abroad and needed Wi-Fi? Download Saily. Tired of telecom oligopolies ripping you off? Download Saily. Want to avoid sketchy SIM sellers at the airport? Download Saily. Saily might be the only travel app you need. It provides an internet connection wherever you travel and saves you money on roaming fees. It's easy to use, affordable, and reliable all over the world. Saily is the modern, seamless way to get connected without the need for physical SIM cards. With eSIM technology, you can instantly activate service from anywhere in the world. No more waiting in line for a local SIM or dealing with expensive roaming charges. Saily offers flexible plans that fit your needs, whether you're traveling for work or leisure. Plus, you can switch between networks in just a few taps, ensuring you always get the best coverage at the best rates. Whether you're a frequent traveler, an expat, or just someone who wants more flexibility with their phone, Saily's got you covered. No hidden fees, no contracts, just affordable, reliable data wherever you go. Visit Saily.com/Loonie Hour for 15% off. Speaking of earnings, Dan Kelly, who's the president and CEO of the Canadian Federation of Independent Business, he noted today that Canada's small business owners have lost $1 billion as a result of the Canada Post strike, about $76 million per day. At a time when it's supposed to be the busiest time of the year for Canadian small, medium businesses, right? Heading into the holidays, having this Canada Post strike. Of course, nobody in Ottawa wants to step in, given the political hot potato that this one is. So everyone's just kind of put their hands up in the air.
Isn't
Which
that disappointing though, Steve? I mean, the Canadian government, they're for everybody. They're not there for one union or one group of
yeah.
workers. And like who's benefiting, from this strike? And I know people, of course, who work for the Postal Service as we all do and everything. But again, when you're working in the public sector that's providing a service for the country,
Mhm.
at some point it's okay, this is enough. And of course, they didn't strike in the summer or the fall. You wait
Yeah.
for Christmas, where you have the most
Oh, the
leverage to
timing's
do it.
horrible.
Yeah, but describe a bit more though how it's affecting small businesses.
Yeah, I just think, for small businesses, if you're relying on Canada Post to get your products out the door. So I just been reading a lot of Dan's Twitter feed. He's quite active on there. But it actually coincides with he's been quite vocal about the GST holiday refund, whatever you want to call it, which is from December 15th for 2 months. The Canadian government, of course, says, you don't have to pay GST on certain items. And so this is actually, we talked about it last week, throwing a wrench through a lot of these small businesses, which is they're like, well, what's GST exempt? What isn't? I have to update all my POS point of sale systems. It's become like an accounting bookkeeping nightmare for all these small businesses while they're also grappling with, a weaker consumer and with Canada Post strikes. So Dan gives a good example here where he was 10 days back and forth with the government and he finally got some clarity from CRA. But he gives an example where he says, talks about like a model plane, like an airplane. He says, model plane that is designed for use by a child under 14 years of age would qualify as a model, and it is therefore subject to GST, HST relief during this period. If the model plane is sold as one bundled kit for one price that includes other accessories within the kit, such as paint or glue, the entire kit is relieved of GST. However, if the paint or glue are sold separately, such items do not qualify for the relief. It's like he's listed all these examples on his feed. It's like it's unbelievable. I'm like, if I'm a retailer right now, I'm just like, I don't even know
Okay,
what
so
to do.
this sort of ties into it. I've now, because I'm into counting big numbers that we've already established.
Yeah.
Okay, here we go. Trivia quiz for Loonie Hour
Uh-oh.
co-host. How many pages are in the Income Tax Act? I have it now. I have the
100,000.
number.
100,000.
No. Steve?
8,000.
3,300.
It's still too many pages.
That doesn't seem like that many.
Man, it's longer than Gone with the Wind. I mean, if you're reading that one, we know that. And another perspective. How many pages are in the table of contents?
30?
Well, yeah, Rich is good day. 33.
Okay.
Think about you open a book, the table of contents. Usually it's like a one page
Hey.
or yeah, like this is big. But this goes to your point though, Steve. It doesn't work. All this stuff is coming to a point where it has to change. So anyone in Ottawa listening, you just can't continue. Like we're this path trend we're going down. We had to talk about Korea, of course, a few days ago. This is
Yep.
similar. This is kind of similar, the same path. And the
No, it's
French and
France is
everything.
similar. France,
Oh,
Korea
it's-
is a different story. But
So these some of these small business owners have been replying to Dan here. So one guy's saying, yeah, he's like, well, why don't you just go from Canada Post to start using UPS? He says UPS is delayed; they're not picking up for 2 to 3 days due to backlogs. All the couriers are full, and one person was saying that shipping a package to BC via Canada Post used to be $26 for them. Today they ship the same package via FedEx. The bill is $48.
yikes.
So again, like as a small business right now, it's tough times. Tough times. So hopefully, I don't know. I guess this all relies on Tiff Macklem to come in and save the day next week.
Yeah, that's all we got to do. Cut interest rates to zero and everything will be perfect and work out really well. One argument with respect to the Postal Service that I didn't like and I thought it was kind of stupid was saying, oh, the Postal Service loses money every year. And I think that's, two things can be true. You can think that those Postal Service people are getting paid too much money or there's maybe too many of them. But to use that as a particular counter argument for why it shouldn't exist at all is also dumb. I mean, hospitals don't make money. I mean, in Canada, I mean, the police don't make money. There's lots of services that we have and rely on that don't make money. And so you can, I think I wanted to like attack that argument because there's obviously lots of sort of externalities and knock-on effects from having a well-run and functioning postal service that are not necessarily related to whether or not it is profitable in and of itself. I think the other thing that's really important is that you mentioned UPS. I mean, a lot of these companies might be permanently scared off from the Canadian Postal Service if they find a better service or if a private company comes in and does a better job. So that'll be sort of an interesting to see how that shakes out in a couple of years from now.
Because it's what you were talking about, Rich, and I agree with you. We always talk about communism and capitalism and all that stuff. For every company out there, you have a profit center and a cost center. So for every company, your IT help desk and all those guys in there and HR, that's a cost center, so you try to control it. So whereas other parts of your business is a profit center, you have your costs you're associated with it and selling it at a margin. The Postal Service in Canada, is it a profit center? No, absolutely not. Same with healthcare. Everything in Canada should be run as a cost center. But I think people would agree, maybe there are some opportunities to become a bit more efficient.
I got one more example and we'll wrap this part up. But so Dan also notes, he says, I got an email from a small convenience store chain that estimates its franchises will spend 16 hours each, so 800 total hours to implement the GST holiday. Chain wide, it'll cost them $50,000. Because you got to go update and you have to go and update all your prices, right? You got to go update certain items. If you got a whole bunch of items in there, trying to figure out which ones need to show GST, which ones don't.
It's just a bad policy.
Well,
it's not
to give you an example, in the Income Tax Act, I just searched GST.
I love the Income Tax Act.
Yeah, this is only on page 18, so you're just getting started here. But on Section 8, I'm going under Section B, 8B, if an amount is included in the capital cost to a taxpayer of a property described in subparagraph 81JII or 81PII, and a particular amount
Please never do that again.
That's only on page 8, guys. Like there's another 3,303 pages to go with this stuff.
All right,
okay,
let's talk
about housing, GST. What else?
Let's talk about something a little bit more exciting. Tiff Macklem, Bank of Canada, he's out next week. We got Bob Sakamoto, Ben Rabideau coming on the show next week to chat post rate announcement. So we're looking forward to that. He's a popular.
We got to
fan.
put our Loonie. We got to put our Twinkie lemon loaf bets on.
Yeah, he's a popular guest of the show. So we'll let's get to that. So what's the Keith? What are the market odds to sort of splice this up here?
So right now the market is pricing in a 38 basis point cut.
Okay,
which
so
for everyone following along the game here, Loonie Hour math, that's not possible. It's either 25 or 50. So so this is what we would call a live meeting. So no matter which way the market, no matter what is announced by the Bank of Canada, the market's going to say, what the heck? We weren't expecting this.
Yeah, so it's about a 50-50 draw at this stage, whether it's 25 or 50. Correct?
Exactly.
Yeah, absolutely. Yeah, absolutely.
Okay. So
and I'm still tossing my number around here, like that Great Wall of China.
Who wants it? Who wants the first crack at it?
I'll go first.
Wait, just drum roll.
Just to keep my losing streak alive, I'm going to say they're not going to cut.
Okay, come on.
All right.
Just an idiot. Come on, give us a number.
25 basis points. They're going to cut 25 basis points. And I can explain why when we talk about the U.S.
I thought you were going to say 38. Okay, Keith.
I've been doing a lot of deep thinking about this, and I'm going with the 25 as well. I'm down for 25.
Yeah. I mean, I had 25 too. So this is consensus.
Sure.
No, consensus 25.
We can get the whole lemon loaf, not just the slices, like the entire thing to eat. That would be fun. Okay, so I mean, obviously next week is going to be, and we
You
should
know
get a
what?
number from
We should have
Ben
got a
as
number
well.
from Bob Sakamoto, but I'm pretty sure, knowing Ben's sort of research, I suspect he's probably leaning towards 50, but I don't want to put words in his mouth. So
But it's one thing to guess, we're professionals. We don't guess. Our forecast is what we think they should do, as opposed to what we think they're going to do. So I think, Rich, you or Steve, one of you guys just made a comment relative to what the Americans are going to do, and I
Yeah,
think
I did.
that's,
I think it's
I
really
think that's
important.
a really. Why don't you explain that a little bit more, Rich?
Well, yeah, I think we have to. It's not a TIF Macklem is not in a vacuum, and Canada, as much as we'd like to pretend we are the only country we exist, it's actually kind of the opposite. And I think that we've talked about interest rate differentials before, and we talked about our most important trading partner, and we've talked about the loonie and how important that is, and of course we've gone on and on about that. And we have to, and yes, Tiff will say he does not, or they do not consider the US currency or interest rates in their policy framework. All they care about is inflation. I call bullshit on that, and I think Keith would agree. I think they're absolutely clued in on what's going on with respect to interest rates and currencies and the economy, etc. And the reason I set that up that way is because just yesterday Powell said the US economy is in very good shape, and there's no reason for that not to continue. The downside risks appear to be less in the labor market, on and on. And, effectively what he's saying is, and then he goes on to say, so the good news is that we can afford to be a little more cautious as we try to find neutral. And he means cautious in the way that they're less likely to cut. And so what that means is that interest rate differential will continue to widen if the Bank of Canada comes out and cuts 50 or 75 or whatever basis point. Now, we know that Carolyn Rogers said that there's a lot of room or more scope, or I can't remember exactly how she said it, for that interest rate differential to widen. And I say you got to be careful because because of things like inflation coming back and the cost of food which we import and a bunch of other stuff. And so I think that they'll be relatively cautious. That's my sort of forecast, not a guess.
After hearing that, I want to change my answer. You know what? I'm going with the 50. I'm going to change
That
it.
was
Yeah.
very sensible.
Yeah. This is where I'm going now. I think what they might, as opposed to statistically, what they're showing here. I think they are incredibly concerned about a sharp decline in the Canadian economy and the housing market and credit markets and so forth. So, yeah, I'm going to change it. Instead of a quarter, we're going to go for a 5-0.
I think that's the
my
first
number.
ever change mid-episode.
I know. Like it's almost human-like, isn't it?
Well,
So I
You
mean,
change
what
it,
you're
Steve?
saying is that the
Steve,
credit
you should change
spread.
too, Steve.
no,
Then if
I'm
we're
sticking with
both right,
25.
because if we're both right, we get to enjoy it, and Rich doesn't.
That's true. But what you're saying, Keith, is that that spread, that interest rate spread differential that we've seen is at a 25-year low. Will probably be what, a 30-year low, and the currency, and this is but plays on one of our themes that I think Steve started and we've sort of piggybacked on, which is that they're going to sacrifice the Canadian dollar in order to protect, as you said, the economy, or try to protect the economy. I'm not sure if it's going to help, and households. And also, it also reiterates the fact that we are absolutely not in a vibe session. We are in, as Stephen Poloz said the other day, already in a recession. And so that's what you're basically touching on. That's your view.
Yeah, I think as well. If you think about it, though, say, hey, they're going to let the currency slide and stuff. So let's take up a list of all the positive things on one side of the ledger that's
Okay.
happened with the Canadian economy, and all the negative things from the economy and policymakers. And it's a pretty big list on one side relative to the other. And despite all that, Canadian dollars moved, in line with all the other non-USD currencies. So, I could see some confidence from the Bank of Canada that, no matter what we do, the Canadian dollar is going to be fine on a relative basis. On a G7 basis, it might be one of the top four.
I
Yeah.
mean,
Get it?
What's going on?
Yeah.
What's going on in the Euroland?
oh, lots of good stuff. Lots of good stuff. I mean, let's start with France because France is.
I don't understand
France.
French politics. So you know.
Okay, I don't understand the presidential system and the parliamentary system. That to me is it's I will do better. But what I do understand is that for the first time in a long time there was no confidence vote. And the reason there was no confidence vote is because they were basically incapable of passing the recent budget. And this has forced the prime minister, Mr. Bernier, to basically effectively he'll have to he'll resign or be replaced by the president, Macron. I know that's kind of complicated, but what's fascinating about this is a couple of things. Number one, he was attacked by both the left and the right. So there was like a bipartisan attack on the quote unquote center. And that creates all kinds of really interesting issues going forward. No one really understands. And the other thing is really interesting is that the French government bond spread over Germany is now at a 12-year high. Now, spreads are the way that you assess risk, either credit risk or liquidity risk or market sentiment risk. And so people are increasingly worried about the France's ability to pay down their insane debt. It's about 110% of GDP. And you know why, Keith? This is my quiz time. Because France is incapable of running a budget balance. And I'll let you guys guess the last year that they ran a budget surplus. Go ahead, take a wild guess.
Ooh, there's a lot of good trivias here.
Is this like Marie Antoinette era stuff, or is it a bit more recent? What are we looking at? I'm going to say it was 1984.
Okay, not a bad guess, Steve.
I'll go 1996.
Both wrong. Keith wins. The last time the French government ran a budget surplus was 1974. And what they want to do, which is absolutely remarkable. Absolutely remarkable. And now the problem is, of course, if you run infinite budget deficits in a world where interest rates are coming down, it's relatively okay because your interest rates go down, interest payments go down, etc. But now as interest rates are going up, it's becoming an increasing burden on their budget. It's starting to hurt their competitiveness, their investment, economic growth, on and on and on, and knock-on effects. And so this is just something to watch. This just happened a couple of days ago. Like I said, I don't really understand the ins and outs of their parliamentary system. It's way too complicated for me. But
I think though the budget that was proposed, I mean, this is clearly a political move, and
they're running. One last point. They're running about 6% budget deficit, so it's a humongous budget deficit. And all they wanted to do was basically raise taxes and cut a little bit of spending to rein that in, and everybody squawked. And so whether it's highly political to get rid of Macron, whether it's because the French are incapable of running a balanced budget. It's just a really interesting thing. And this is the second largest economy in the Euro area. And it's definitely something to keep an eye on. But anyway,
so I think, is it the Maastricht Treaty? They have to be at 2%?
3.
3. Okay.
And the other part of the Maastricht Treaty is that they're not allowed to have higher than 60% of GDP, which is a joke because France is almost twice
debt to GDP. Debt to GDP.
Sorry. Debt to GDP. Excuse me. So it's just a total cluster F. And
it really is. And so we have that happening. And remember, the budget was actually to reduce spending growth.
Right.
It's like saying inflation's come down. No, it hasn't. It's still increasing at a slower rate.
Yeah.
And that's why it's kind of similar to what happened with the Brits there about a year ago. Was it Liz Truss? Was that her name?
Yeah, that's exactly right. Yeah. So
like
Liz Truss lasted 45 days, and this Mr. Bernier, who's the prime minister, lasted I think 90 days or so.
Seems like there's a reoccurring theme here in terms of government deficits and financial markets giving them a bit of a run here, right? You had the UK, you got France. There's some issues in Germany. I mean, even in Canada, right? People are complaining that there still hasn't been an updated number on the deficit. It was supposed to be released in September, and we are in December, still no numbers. So
it's part of this whole global risk is synchronized theme, that's happening. So I want to introduce a really cool idea in a minute.
Okay, well, 1 second though, because should we talk about Germany, or are we
Go
bored
ahead.
about Germany? Well,
Yeah, it makes sense. Let lock and then jump over to Korea as well, real
yeah,
quick.
exactly. So I mean, Germany. We've talked about this a lot, and it's just I won't spend too much time on this, but just an ongoing theme. You've had now. I think there's basically a dozen different companies that um, have been cutting employment. But the best thing that just happened, and the word Schadenfreude is pleasure in other people's pain, and it's like a great German word, and I think it perfectly illustrates what's going on now. But what we're seeing is because the wind, so compounding on poor growth because of high energy prices, global trade is slowing down. They're not sort of geared up for that. China's eating their lunch. It's all sort of coming together. And then this week, Germany's weak winds trigger record surge in gas-fired power. So because their energy system is not fit for purpose and they've turned off their nuclear power, we've seen a record increase in gas-fired power supporting their energy grid. And it's all imported, of course. Some of it's imported from France, so it has a pretty solid system. But it's really just a fascinating sort of continuation of this trend. And it's obviously affecting their economy, and then the knock-on effects to the euro are really important, and of course politically, because in February we know there's going to be an election, and the AfD, Alternative for Deutschland, has made it explicit that they want to get out of the EU. So over the next couple of months, you're going to have two of the most important economies in Europe, both of them sort of on their knees economically, going to have elections. And there's a lot of risk. You really have no idea which way it's going to sort of end up and turn. And it's just really, for me as a strategist, I'm always sort of I really kind of enjoy this kind of stuff. I know it's horrible to say that, but it's true. That's how I feel.
What, Rich, wasn't there a discussion recently in Germany that they're kind of discussing about reopening these nuclear power plants?
Yeah. So one more thing on this. So it was actually, I think, leaked by a bunch of, this is the news on the street, is that it was leaked by a bunch of engineers that have sort of like basically laid out a path to reverse course on this, what was 100% a political decision, and nothing to do with whether or not it was viable or not. It was purely a political decision that was rammed down sort of German industry. And a bunch of engineers sort of got together and sort of laid out how they would do this. I think last week I said it takes about a year. I was wrong about that. Somebody was gracious enough to tweet me and give me that figure, and it's much more closer to 3 or 5 years. So it's a big fuck up, basically. It's a much bigger deal than I thought it was to turn back the nuclear power plants. Who knows what will happen? Germany's industry might be completely collapsed by then. So
they screwed themselves for the next 3 or 4 years at a minimum.
Yeah. Anyway, there you go.
A lot can happen in such a short time frame.
Yeah.
Sort of similar with this, a real interesting weird event happened in Korea a few days ago. People were following it. Out of nowhere, the prime minister instituted martial law. So effectively, hey, everyone in your apartment, I guess they have over there, and don't come out, and and let's suspend government and everything like that. So this is interesting for a couple of reasons. One is how fast it happened, and then two, why it happened, and three, what was the result. So the result, very quickly, it got resolved within 3 hours, I think. Effectively, they locked the doors on the elected government officials, so they couldn't get back in the building to vote to say, hey, you're wrong, you're screwing up. So there was actually a tussle, and the police and military, they didn't know who to side with. It's actually one of these really cool moments where they said, you know what? I think the people are right with this instead of, the prime minister. Then you say, okay, what the heck happened? And the prime minister, I think the official narrative, Steve, I think it was something like, our democracy is under attack and things like that. And, you always hear that, of course.
We've heard that before. We've heard that before.
Was that the case, Rich? What was really, was democracy under attack? No.
That sounds so familiar.
Freezing bank accounts.
There was allegedly a little bit of corruption going on with the prime minister and his wife and so forth. So, but again, this should capture your attention as investment managers. It's just so interesting. It's exciting in an insensitive way, in that everywhere around the world now, we always talk about this synchronized risk. It's right in front of you. If you're unable to see this, then you
So,
just don't deserve to see it. Steve.
yeah, I have a question for you on that side. Like, if you're a large financial institution or an institutional money manager, and you see the events that unfold in South Korea, does that cause them or you to pull your money out, or at least a portion of it? Like, do you like, oh, well, this country looks sort of unstable, doesn't maybe look that friendly to capital investment. Maybe I should shift my money out of South Korea and move it to wherever else in the world. Like, is that, how real do you think that scenario is?
Oh, it's absolutely 100% real. So like when this was happening, the currency was down 1 or 2%. Same with equities and
Which is
stuff.
a huge move in currencies.
Yeah, and local markets weren't open. But if you are an institutional investor of any kind, and all of a sudden there's martial law imposed, and like that doesn't happen in the so-called developed world, it just doesn't happen. All of a sudden you're sitting there, you're thinking, like, my God, we have $40 million on deposit with XYZ Bank in Seoul. We got to get this out, because how long is this going to go on for?
Mm-hmm.
It could go on for days, weeks, months. Your capital it just vaporizes in the middle of the night. So it is an absolute risk. And now, you obviously this is what political risk is for any economy and market you're in. You always want liquidity. We talk about China all the time. Hey, there's no liquidity. You put your money in, you're going to get it out. Maybe, maybe not. We'll see. You put it in the US market. Are you going to get your money back the next day? Yeah, absolutely. Unless you're in some kind of a liquid investment like private credit or something. So but it is a big event, Steve. So with us, I want to talk about today. So I know I've ever done this before on the podcast.
Use your calculator, because that was brutal.
I know I've done some really like sharp things before. But I just want to talk right now. So very quickly, in our mind and view right now, the probability that markets are reaching a high has gone up to a point where it's not like, hey, this is the top tomorrow, get the hell out. But it is looking increasingly liking that we are going to see a shift here coming up. So there's lots of sentiment models out there. You also have anecdotal. We've seen some people recently, hey, all of a sudden they become stock pickers, and they're just going to start picking their own names because, hey, tech market was up X% over the last 12 months and all that is happening. But overall, what we're seeing here right now, so there's 300 trillion in global debt, right? There's more than 300 plus in it. About a quarter of that debt is going to be rolled over now, this year, next year, year after, and it's going to be at least 1% higher than what it was at. So what's 1% on 300 trillion? Steve?
3.
I'm not doing this.
It's 3 trillion. That's 3 trillion. That's a lot. That's a lot of zeros on my calculator. But we're running into this situation right now where people are very dissatisfied with governments. Like even the US, you got the whole pardon story that happened. By the way, maybe you can pardon me for my Twinkie bet next week. We'll see. But the same thing politically in Canada, France, Germany, the UK, we have that side happening. The amount of debt that is now outstanding, and it's going to increase because deficits are now increasing, and debt that's coming to due is going to have to be rolled over at even higher rates than previously. So the interest burden is increasing. Credit spreads are at one of the tightest levels we've seen in a really long time. And all the other previous times with spreads this tight, you really had no one with economic growth as grinding tighter and tighter. And then when you look on top of that, volatility is just quite low. And then some of these other models we look at, which measures the strength of the market, it's pretty strong, but it can't get stronger. So it's reached that point where, hey, as a professional manager, you start to get concerned about this. And, most people, buy high and sell low. It should be your goal to really to sell high. So I think we are at, and whether I'm not saying it's going to be tomorrow, the next day, it might be over the next few weeks or a month into the new year. But this is at a point now where this could roll over. And then the other overriding factor with all of this, and I think Rich, you pointed that out recently, if the American economy is still doing okay, and the Fed is not in this dovish camp, it's going to suck capital out of everywhere else as well, and that just accentuates the whole process. So Steve, yeah, I'm worried right now where markets are. It's been a great year. Everyone's had a good year. With their investments around the world. But
Lock in some profits.
yeah, should you be adding to it now? Maybe, but we'll see here coming up. So it's going to be exciting as we turn the
Big call.
I remember, I think that was 2018, guys. You might remember that was on Christmas Eve.
I remember that,
yeah, a bunch of friends now. We always go to one of the pubs, here locally on Christmas Eve, and Marcus were just getting absolutely mullered that day. And none of my friends are in this world, hey, like they've already shut it down like 2 weeks before, and I'm just sitting there like having a pint, and then, oh man, this is not a great way to end the year. Where we're headed. So here we are on Thursday. We went on Thursday. It's only December the 5th. We could have 3 weeks left. So, hey, enjoy the moment.
Enjoy the moment.
Enjoy the moment. Was that what Tiff
Enjoy
said?
the moment. Yeah. We'll
enjoy the moment. Stick
we'll
the landing.
Stick
the
the
landing. We'll have another moment next week to discuss again with guest Ben Rabideau, who's been on the show before. So looking forward to that. He didn't text me back about his market prediction for the BOC, but I'm guessing he's going with 50. So we'll see. You have to tune in to find out. There she was.
That's it. That's
Gone.
gone.
There she was.
All right.
Okay, cool.
Thanks for tuning in, everyone. Appreciate the support, and we'll see you next week.